Hi, my name is Jules Maringer, and I'm a sophomore studying economics and business at the University of Michigan. Today, I'm going to bring you my findings for the 2017 CQA Challenge. First and foremost, I'd like to thank the judges for sponsoring this competition, and I'd also like to thank my mentor, Kai Patainen, who's the manager of the trading floor at the Ross School of Business. So let's get to it. For today's agenda, I'm going to be going over my investment philosophy and process, my portfolio construction and the trades I made to rebalance the portfolio, and the risk and return expectations, and finally, the overall stock portfolio performance and attribution. Quant investing. I know the judges here know what quant investing is, obviously, but if there are any viewers out there that might want to participate in this competition next year, here's a little rundown. It's different than traditional qualitative investing. And what that means is that quant investing relies heavily on mathematics and the use of computer algorithms to pick stocks, instead of analysts going to companies, seeing what sort of goods and services those companies provide, and seeing if that's a good company to invest in. Quants are not necessarily interested in the actual good or service that that company provides, more that is this a company on paper and through the numbers that can do well. And one way to quantitatively invest is through factor investing. And so factor investing, it's a strategy where you're choosing different stocks and different securities based on shared commonalities among those, different sort of attributes. And so in an effort to rid and eliminate error that comes through human emotion, you might think that one company is good because you see you're wearing their shoes and you see other people wearing their shoes, but in fact that company might not do well in the coming months. So when screening the different stocks, these are some of the factors that we used. Mainly we used value and momentum factors, so different ratios like high book to price ratio, high book to market. And for momentum, we used a high EPS price impact ratio, and then we also thought that we should go long in those stocks that have been doing well over the last 6 to 12 months. Typically, stocks are continue to rise if they have been rising for half a year or over a year. And we shorted the stocks because it's a market neutral portfolio. We shorted the stocks that did not fit this criteria. We're pretty much the opposite. So optimization. So we picked the stocks and put it into our Barra Aegis portfolio optimizer, and we had a few limits and constraints that we had to follow. Like we couldn't put more than 5% of the money in our portfolio into any one stock. We had to account for transaction costs. We had to have a target beta of about 0 to minimize the portfolio's risk. And then we had to have a long-short ratio of about 1, which means that we had to have an equal amount of money going long in companies as well as short in companies. And once those stocks were put into the quant screen, out of the Russell 1000, we took the top 40 stocks and to go long in, and the bottom 40 stocks to go short in. And that was based off a 1 to 10 ranking. Following the rules. So the competition had a set of rules that we had to abide by, and we actually made an Excel spreadsheet that linked up to FactSet to make sure that every day our portfolio would not go past the different limits. So our beta had to be between negative 0.25 and positive 0.25, and the long-short ratio had to be between 0.95 and 1.05. And this made us kind of have more of a disciplined approach, because we put a lot of time into constructing the portfolio, and we wanted to have a hands-off, disciplined approach, putting faith into what our computer model said, what stocks were going to do well. So this was our Excel spreadsheet spreadsheet. And here we have the longs, the shorts, each company that we invested in, and it would update in real time, which is really cool. So let's go to individual stock performance. We had some winners, we had some losers. Some winners that we went long in was Westlake Chemical Corporation, went up 16%, and then two other companies that really performed very well. We also shorted a few companies that also did not do well but benefited us. So we are currently, we have a position in Tessera, and it's down 26%, as well as Equity Residential and Regeneron Pharmaceuticals, which is down 16%. Now we had some losers, and I made some mistakes when rebalancing the fund. I shorted EMR at $59, and I actually had to cover the position at $72 because I felt that it was going to go up even further. And here are two other stocks that didn't help our portfolio. And here's just a picture of where we shorted EMR and where we actually ended up covering it right here. And this is where we shorted Tessera, and it's actually below $60 today, which really benefited ourselves. So the Axioma risk reports. Our active risk of the portfolio was about 7.69%, which, given that we shorted 40 stocks, is actually very good. 55% of the risk came from common factors. 18% of the active risk came from our style tilts, and then about 30% came from our sector bets. So we'll go into the sector bets. So style bets, we were overexposed to momentum, which makes sense because two of our parameters was that we were going to invest money into the stocks that were trending upwards, and we were going to short the companies that were trending downwards. And we were also overexposed to earnings, yield, and value because, as you saw from the previous slides, we had about 6 or 7 value factors and ratios as well. And we were also underexposed to leverage. So here is a line showing how we were overexposed in momentum. Sector bets. So we were overweight in financials and consumer discretionary, and that contributed to a lot of the risk in the fund. We were also underweighted in real estate, and that also contributed to our active risk. So here we are, we're overweight in financials, underweight in real estate. And stocks and risk, here Micron Technology was our riskiest stock that we invested in. It was really volatile over the past quarter, and here Tessera was also very volatile, but it worked in our favor. Vectren Corporation was a stock that wasn't very risky. It really just followed that trend of the S&P and the Russell 1000. Medium-term momentum and how it hurt and helped us. This kind of goes back to overall stock performance and attribution. At the start of the competition, as you can see, our momentum factors really did not help us, okay? However, in January, when the market went down, tremendously, our momentum factors actually kicked in. And so as we see this line going up, sort of where we previously started. Overall, some of the key takeaways and the lessons that I learned was that to be a quant investor, you have to be very disciplined. You have to have faith in the model that you created in the beginning will work out. You can't think that in the first few weeks or even the first month, you're going to see the return that you hope for. And that's what I learned from this competition, that the discipline, the hands-off approach, and the putting faith in your model. So again, thank you to all the judges for sponsoring this competition. I thoroughly enjoyed myself. I have one more month to become #1, and thank you.